Hey everyone, thanks for checking out this video. I'm Mike Castronovo, and I've got the honor today of sitting with Dave Herbst, who's been involved with the All-in-One from its inception in 2005.
That's right.
That's how young we are. But Dave, I had this opportunity to spend this time with you, and we spent some time earlier today, but just to share with the viewers just some of the questions that I have that kind of come up more infrequently, as secondary questions.
Sure, bring it.
Great. One of the things that people always ask is, if the All-in-One is so great, why aren't other banks doing it?
It's a good question. We get this pretty frequently. I think naturally people are looking for the holes, sort of the devil in the details, and naturally people are skeptical, about mortgage financing, especially anything new that comes out of our industry, as you know, and for good reason. I would argue that we're probably not very well known for innovating safe products, right, in our history. This product is the opposite of what people have experienced in the past. The reason why banks and lenders find it challenging or just don't want to venture into this realm is really centered on its structure. The All-in-One loan, as you know, is a combined 30-year line of credit, 30-year draw line of credit with integrated personal banking. So we've merged together home financing and the management of income. So the mortgage becomes the storage place of income dollars as they sit idle, waiting to be spent on living expenses. And it makes it very fluid to utilize these dollars versus idle money sitting in a standard checking account. The benefit with the All-in-One loan is in using the mortgage as the storage for idle money, if even for a day, is that it reduces the interest cost people have to pay on that loan that month, then the next month, then that year, and ongoing. Right, so there in that answer is the reason why banks don't offer it. Most banks are a deposit banking institution where they try to attract depositors. The benefit to this business model is that deposits remain sort of isolated in a facility called a checking account, and it allows that bank to actually leverage those dollars and make additional loans out of, other security instruments out of, to earn some interest income. The All-in-One loan actually allows that money to flow through the checking account and into the mortgage, which is costing an arm and a leg for our customers. And we recognize that flow of money and that management of those dollars and allowing them to sit inside the mortgage to reduce the cost of the mortgage is beneficial for people. And we're not a bank, so we don't have the problem today of needing deposits. We want to see those deposits move through, lower the cost of mortgage financing. And that's simply not the model that banks have engineered through, offering deposit accounts. Other lenders, tend to not venture into building an All-in-One loan product because it takes a lot of effort. It takes a lot of resources. Education is key. As you know, we take that very seriously. Developing tools to assess suitability and potential benefit is incredibly important. It really is what it comes down to. That's why we have a great track record with it in terms of performance. And we just don't see a lot of lenders have that sort of, appetite or fortitude, lack of a better way to put it, to invest dollars in doing that. The traditional mortgage side of the business is still lucrative enough, I guess. But we see things, I think, slightly differently, and know that there's power that could be harnessed inside of people's paychecks. And if we put that money to work to help them lower their costs in life, we help strengthen the housing market, not weaken it.
Yeah, absolutely. Great product. That's the reason I'm here.
Yeah.
So one of the other questions that comes up, a lot of people today, well, I guess, it's just been growing in popularity, I guess, because of the internet. People have learned about the concept of velocity banking. Mm-hmm. And, I kind of call it the younger, weaker sister of the All-in-One in a sense. But, what are some of the advantages of the All-in-One to velocity banking for people that are, I get a lot that come to this channel here, and they were started out looking at velocity banking, and they stumble across the All-in-One, and they go, what's this? This looks like it might be the same or a little close.
Sure. I love the question. I love meeting people like that because they're on the right track.
Yep.
Right? Exactly. I mean, people that are thinking about prepaying their mortgage down, or maybe they are already doing that, or they're using velocity banking, and there's a variety of other different strategies that have existed out there, and they have for decades, by the way. This is not a new concept. Right. The concept is utilizing cash flow, income earned, if even temporarily, even overnight, to offset costs associated with a big debt that's tends to cost you more than any other debt, being housing debt, and freeing up cash flow to help grow other investments or just simply to pay off the debt. Strategies like this have existed from velocity banking and other ways to do it for a very long time. Those, as you put it, are pretty cumbersome. They take a system, they take a strategy, they take really on-hands effort, and just like a diet, sometimes you set out on the right path and you don't necessarily stick to it, right? These are all well-intended, but having a strategy in which forces you to use a variety of different tools in order to just achieve maybe some interest savings can be something that takes a lot of effort and cumbersome, and something that people just don't stick to in their use. It's not that they're don't have the right intent, it's just that by design they become very I think cumbersome to use. The all-in-one loan is a more practical way to approach it because it achieves everything that somebody is wanting to achieve in their life, which is interest cost savings and cash flow development. Save more of your own income dollars from having to commit towards mortgage expense by placing your income dollars directly into the mortgage and letting it work for you until you need it. It's practical, it makes sense, but it's also automatic. The all-in-one loan makes this process automatic. So imagine waking up and saying, I'm going to stick to that diet. We know that's hard. But what if somehow
What are you saying here?
But what if somehow it happened for you? You know what I mean? Without you even having to get off the couch. This is sort of the equivalent. It's a checking account bolted on to the mortgage. Just by using a checking account like everybody does already, your money goes to work and allows you to reduce what you have to pay out on that mortgage automatically. That frees up money. That money, if kept in the mortgage, could continue to offset cost and pay it off even faster, or that freed up money could be utilized for outside investment activity, securing your future. Maybe retirement's important right now for you, funding your kids' college tuition costs, all the other things you have to pay for. But this just simplifies the strategy because it's all built into one.
Yeah, fantastic. Another great question is, why would a financial advisor want to recommend this to their clients? Don't financial advisors want to get all the money flowing into them instead of flowing towards the bank and paying down the mortgage?
Sure.
I grew up in the industry. I've been doing this for 26 years, and it was always the, carry a big mortgage and invest your money. So why would, as a financial advisor, I want to bring this to my clients?
Yeah, that zero-sum game, you can't achieve this without doing that, it has existed for a very long time. And if you think about that mindset, that way of thinking, it's really been developed through, as I put it, the sort of the optics, the lenses of traditional financing. Of course, that makes sense. Why would you want to pay off a mortgage and put extra dollars towards the mortgage to even though it's going to save you some time and money? Why would you want to do that with a traditional mortgage when that traditional mortgage is going to lock those dollars up permanently in mortgage prison, so you can't utilize them, right? So. From a practical standpoint, that advice still applies. In traditional mortgages, it creates maybe potentially an unsafe environment where you're less liquid, right? And you have less to use for emergencies or to invest with and all these other things. So an advisor is interested in, utilizing money effectively, helping it grow. And with traditional mortgages in mind, that's very practical advice. Now enter an all-in-one loan into the conversation. This is something that an advisor may not know about, right? So, this is where we come in. Let's educate advisors on how the all-in-one loan keeps that money liquid for use. But here's the special thing. Here's the real powerful part of this. The all-in-one loan is using non-investable money. All of it, right? All of the money earned that needs to flow through a checking account that a client will use for their groceries this coming Saturday, or their utility bill in 2 weeks, or their cell phone bill in 3 weeks. All that money is non-investable. That's not going to be placed in the market, invested. It has to remain liquid. And we use these tools called checking accounts. Every single mortgage borrower uses one. And there's more money that flows through a checking account in just the course of 5 years than the amount owed on a mortgage today. Right. For the average person out there. Utilizing that money, which is non-investable, it's money you can't lock up, can't invest with, placing it inside the mortgage to reduce the friction the mortgage causes on that person's life in interest cost, to do what? To help them retain more of their income, right? Yeah. If you spent less money on interest on your mortgage, you'd have more of your money available. Exactly. Well, guess what? That helps the advisor, right? Because we're freeing up cash flow. We're developing cash flow by interest avoidance. That now benefits the advisor. And holistic advisors know this. They want to, help protect, their clients' assets. They want to invest more money. They want to manage that money and make sure it grows safely. There's a variety of other things that are on their minds to help achieve. And simply put, if their clients had more cash flow, more positive cash flow each month, they'd be able to actually execute on some of those strategies more aggressively and sooner in that client's life, which helps them, right? Especially as they approach retirement. This bolts on perfectly well, very powerfully with a financial advisor's strategy because it's all built in one place.
Yeah, great. All right, well, you've answered all the tough questions, so I'm going to give you a softball to end up here with.
Okay, thank you.
So, realtors, they just want to get the transaction done. They just, hey, here's my client, get them a 30-year fix, get them in and out the door. Why would I even want to bring up the conversation of an all-in-one?
Yeah, they have a lot to lose, reputationally, right? So I think their focus is really, primarily based on, getting this done, getting it done on time, and rightly so, right? I think that what's new to them is that the mortgage actually matters, right? Yeah. What we set in motion actually does matter. Right. This is a part of the business as we're sort of joined at the hip, real estate agents and mortgage professionals, as we're sort of cousins jointly, helping people get into home ownership and acquire real estate and better manage their real estate. The part that I think is often missed is that what we set in motion in terms of mortgage debt and the repayment schedule and how long people are going to remain in debt and how illiquid they are during that journey can actually add burden to people's lives. It can actually make them less capable of buying real estate and continuing to participate in the market. Right. For a real estate agent, when you enter in an all-in-one loan into the conversation, we're achieving a couple things. Number one, we're reducing the cost of finance property. Because after all, I know we all focus on the purchase price, but when you add a mortgage into that equation, you're adding nearly double the purchase price in total expense, right? And in total obligation. Right. The mortgage consumes a enormous amount of money. If we could reduce that by a better mortgage, a more efficient way to do it by 20, 30, 40, 50%, then we've just effectively reduced the cost of that financed property. And that's appealing to people today. Whether rates are low or high, the cost of living continues to increase. It's not fixed. And we have to contend with that through life. Well, if we could reduce the biggest obligation we have to commit to in our lifetime significantly, then we put people in a better place. That makes the real estate agent stand out. Without question, they earn more business through an all-in-one loan. The second thing that the all-in-one loan helps them achieve is their clients are able to buy additional real estate sooner in their life. Right. There was a study done a few years ago that indicated that about 20% of the existing housing market dreams about buying again within the first 5 years of their last home purchase. So you buy a home and within the next 60 months, people are talking, they're talking at home, they're thinking about that next purchase, whether it's a vacation home or just an investment, or maybe they just don't like their neighbors and they want to, or they need to move up as their family grows. Whatever the motivation, people are constantly thinking about. Homeowners typically dream about their next home that they're going to acquire and want to live in. And I think we can all relate to that. Identify with scouring marketplace websites for whatever's on the market nearby or in the neighborhood they want to live in. Exactly. So how many of those people actually execute on those goals? Not as many that dream about it. There's far more people that dream about it and do nothing than there are people that dream about it and actually are able to do something about it. Why? Because they're not liquid. Maybe they don't have enough for the next down payment. Maybe they're locked into this interest rate, right? This lock-in effect with maybe a lower interest rate on their current home. They don't realize that they can save money using a more efficient mortgage now to make that purchase, that next acquisition more feasible, more or less expensive. So for real estate agents, the all-in-one loan really kind of changes the paradigm. It reshapes the discussion they may have with people. It's an alternative to traditional financing and reduces the total cost of the home that somebody has to buy. It ultimately also helps take interest rates and the concern of interest rates almost out of the conversation, right? We're highly influenced by interest rates. What if you could get today's interest rate levels, but effectively, in comparison to a traditional loan, you're paying closer to 3.5%. Right, instead of 6, 7, 8, 9%, right? So having a more efficient mortgage that uses money differently really helps real estate agents sell more homes and represent their clients' interest, I think, more effectively.
Yeah, Absolutely. Well, hey, I really appreciate you coming into town and taking the time to sit down and do this. If you've got any questions about the all-in-one, reach out into the comments section below. I've got my numbers down there, my email. Would love to have a conversation with you to see if this is a fit for you and your family. Thanks again for watching.